Jeff Gundlach went on to say that he believes the markets, they probably need at least one cut to keep the rally going, but he's very doubtful about that cut actually happening. Do you agree with him?
So we do think that there's going to be a cut this year. I think what we heard from the Fed yesterday, and certainly from the dot plot, is there's still, first of all, there is no hike on the agenda, at least at the moment, from the Fed's perspective. So are they still leaning towards a rate cut? I do think that as the economic data unfolds, and certainly following on from yesterday's CPI print, there's going to be enough data evidence to convince them to cut. I still think that there's a chance that you do get a September cut, but for that to really be the case, you need to see yesterday's CPI print, that softer than expected print, really being replicated over a couple more months. And you probably need to see some further signs of economic activity cooling.
All right, just for context here, the CME FedWatch tool is now showing a 56% chance of that cut coming in September. Odds ticking up just a bit from a week ago. As we've seen the Fed say higher for longer, investors, they seem to retreat to that momentum trade of big tech. Apollo's Torsten Slok put out a note yesterday kind of highlighting the concentration risk in the market right now, specifically citing NVIDIA, basically saying NVIDIA's been 35% of the S&P gains so far this year, and if it tanks or moves to the downside anyway, that would basically tank the S&P. I want to get your take on concentration risk right now. Is that something that you think investors need to be concerned about?
I think it's definitely something they need to watch because, as Torsten rightly said, the Mag 7, or even I guess it's the Mag 5 in a way now, they are driving the performance of the equity market. But we don't want to exaggerate that too much. I mean, look, we do expect those big tech companies to continue to deliver. We already have seen them deliver already lofty expectations. So that continues to go well. But the other thing that we're seeing is that, look, as long as the economic activity doesn't trend towards recession, which seems very unlikely at this point, you should see a continuation of this broadening of earnings growth to sectors beyond technology. We've already seen signs of it in the latest earnings season. And if that continues, then you should see the performance getting that much more consistent, stable, and something a little bit more credible so that concentration risk becomes less of an issue as you go through the year.
Seema, everybody keeps saying that. We have a chart, actually, since the last Fed decision on May 1st, looking at the S&P, the financials, and industrials. Those are cyclicals that are supposed to benefit from rate cuts, potentially hurt if you have less clarity on rate cuts, and they've severely underperformed. Looking at the S&P since May 1st, up 7.5%. S&P financials up only 1%. Industrials up just over 1%. Everybody says the market's broadening, but we haven't seen investors actually put their money in these other sectors. Now that the Fed signaled higher for longer, why would anybody? I know you're also looking at people with their money in money markets. Why would you take your money out of a money market and put it in anything but tech right now?
So we do believe that technology is going to continue to perform really well. So it's not about taking your money out of tech. It's more about thinking, look, all that cash that you maybe have sitting on the sidelines, sitting in money market funds, at some point the Federal Reserve is going to reduce rates. And it's no longer going to be so attractive to be resting your money in those places. So investors do need to get a little bit ahead of that and think, what can deliver next? At these valuations, I'm not sure you want to be increasing your exposure to technology. So those newcomers into the market, they need to think about what else there is. And valuations in other parts of the market are looking very attractive. And provided, as I said, provided the economy continues to perform solidly, maybe cooling, but still solid, then actually that earnings growth should broaden out and you should see some upside performance to those other sectors and companies.